It's time again for another weekly wrap up, and I'm here with Roger Scott. Roger, how are you?
I'll tell you. Momentum levels are really worrying me. I'm becoming increasingly defensive, and I know I've been saying that for a few weeks now, but my mood is not changing. Matter of fact, internally, for the first time since February, not just the short term, but the long term and the short term trend are both bearish, and you have 46% of stocks trading above the 200-day moving average, stocks that are over $2. So if you look at the S&P 500, if you look at the NASDAQ, James, you'll see that the market is still looks fairly bullish. We're at the 50-day moving average. Even if we drop below, we're still going to be above the 200-day moving average. But if you look at the overall market, we've now been bearish for 3 days. We are now officially in a bear market. And I know you're probably thinking, how could that be? You know, if you look at the NASDAQ chart, it's like this. If you look at the S&P chart, it's like that, but not the overall stock market. Small caps, mid caps are being very, very cautious. You've got defensive sectors like copper, metals starting to make a multi-year high, as we've spoken, and I'm becoming increasingly concerned at what I'm seeing in the stock market right now.
Really? What is it? What is the main source of your concern then?
Well, the main source of the concern is the internals. You know, I'm really big on internals, and what we saw initially after February, what we saw after the market sell-off, we saw the stocks trading above the 200-day moving average rise. That number rose, and in my opinion, and based on the momentum levels, it rose till about 70th, 80th percentile, and now it's turned back down. And with that, the number of stocks trading above the 50-day moving average went all the way to 90th percentile, and now it's at 40th percentile. And typically, after we see that rubber band stretched out to the point where we saw in February, we see it go from really stretched out to really contracting. And usually contracting means about 10, 20% of stocks trading above the 50-day moving average. We're still 40%. That's on the short term. So we're finally seeing the short term and the long term moving on a downward spiral. When you take that into account with the fact that the overall stock market, small stocks, big stocks, are trading at below the 200-day moving average, that we could be at a very let's say at the crest of the tidal wave, as I like to say it. All right, we could be
ominous sounding.
Well, because look, you got to look at the market. You got to look at the market. You kind of have to sometimes open up and look and see what's under the hood, and that's kind of what momentum levels are telling us.
Right.
And I'd love to tell you the opposite. I'd love to tell you that everything is hunky dory, but it's not. It's just not. And the thing is that line continues to move lower. So any sustainability in upside momentum is caused by less and less stocks. There are fewer stocks driving the gravy train, you know, lopsided. These are the kind of words and I don't say this very lightly. And I'm not a one of those pessimists. I'm very neutral, and I say it the way I see it. But we went from, and I'll tell you another thing that's bothering me, James. You see, when we were February, March, we were looking forward to this COVID-19 period being over. So you had all this strength coming into, all this equity coming into these stay-at-home stocks. Remember, the market's always looking ahead a couple of quarters. Well, now the market's looking forward and discounting all this tech and looking forward to the recovery, but we don't know if the recovery is really going to be there. Because if Pfizer comes out tomorrow and says, you know, we had the same thing that happened at how do you pronounce that?
AstraZeneca.
Thank you.
Yep.
And they're still not telling us the extent of the injuries or what happened to that person who things didn't go right. I'm dying to know what happened to that person. I want to know specifically what happened. And this is phase 3 trials. We should have been already way past that. I'm actually very surprised the stock is holding up so well. But getting back to the point, if Pfizer now comes out and says, well, you know, we may be having a little setback, we're we're going to go right back to where we were in March, late February and March. So we're kind of between these two extremes. Is the market going to look forward to getting out of this mess, or is the market going to look back to getting into this mess? In addition to that, James, we've got another big problem. And again, I'm going to tell you, I'm not a big, when it comes to commodities, I think time of year kind of calendar, being on the calendar is very important. But I've never been that way in the stock market. I always kind of look at individual companies. I don't look at what happened last year, the same date. That's never been my thing. And I'm not discounting that. It's just never been my thing. But every time we have a presidential election, we have this congestion period leading up to the election. In other words, if you look at the last 4-year period, the summer was very volatile, just like this summer. And as soon as that summer ends, as soon as that fall begins, where we're at right now, you have a period of congestion and consolidation, and we wait to see what happens. And can you blame large hedge funds for that? Of course not. If Biden wins, economy is going to go one way. You're going to see a strong uptick on pot stocks. You're going to see a strong uptick on renewable energy stocks. You're going to see a huge bull run in Russell 2000 stocks. If President Trump wins, the opposite. You're going to see a big run up in large cap tech stocks. You're going to see a cool off in the Russell 2000 stocks and any stock that has relationship to China. So you have very diverse roads that hedge funds are going to take, and they don't want to they don't want to guess which way the economy is going to go. So you're going to see a lot less influx of institutional capital moving into the market than you would at a typical fall period. So, and if you add that into the mix that we're seeing with the uncertainty because of COVID-19, that leads to a very choppy ride.
Sure. Well, sorry,
yeah.
Go ahead.
No, please.
Well, so it sounds to me like, I mean, from what I've learned from talking to you over the last year, Roger, and it strikes me that, the market has become very liquidity centric. So, you have a situation where the largest capital pools are going to say, well, we're going to take a step back and we're going to see where the chips fall, as it were. And so that basically means the liquidity level in the market is starting to go down. And so as that liquidity starts to bring stock volumes down and prices fall as liquidity withdraws, which catalyzes more selling from the elite sort of segment of the market downward into the retail market, it has this self-fulfilling prophecy effect. And so the liquidity level starts to fall faster and faster. And I think, especially given the fact we've got this election uncertainty, we've basically got bipolar candidates here, combined with the uncertainty surrounding the pandemic. I mean, that's a recipe for liquidity extraction from the market at a tremendous scale. And I think that that's what we're seeing in the data internals, but that you're talking about here.
Yes, exactly. And and in addition to that, we're seeing that because of the election. And in addition, we're seeing more of that because the world doesn't know right now. We're kind of like, between a rock and a hard place. We're between a crossroads. It's kind of like stay at home another 6 months, recovery 6 months. It's like a crossroad. It's like going to two different paths. And we're literally right at the brink of those two paths because people are sick and tired of staying at home. Even people who were scared initially. People are, you could tell, even my folks who are high risk group, my partner's parents, my wife's parents, you could see it on people. People are getting sick and tired of being sick and tired and staying home and all of this COVID-19. People want any excuse. They want any reason. They're willing to buy into the COVID-19 pills and the vaccine. But I'm telling you, even if things go as planned, it's not going to be a smooth sail. And we may have to kind of shift our mind back a few months and go back into the stay-at-home stocks. But then you have this presidential election. So you kind of have this two scenarios that kind of lead us to the same path, if you will.
Right. Right.
too much uncertainty, and too much uncertainty means choppy, directionless market with defensive stocks and commodities leading, which
Sure.
leads me to one of the assets I'm increasingly becoming bullish on. And actually, I'm not going to take credit for this. Jeff, one of Tom Busby's guys, he was talking about it a few weeks ago, and I said, everything you're saying is 100% right. So he was actually looking at the copper market, and he was looking at uh, the futures, but there's an ETF which tracks it brilliantly, 95% correlation. CPER, high grade copper ETF, making it, I think, a 2-year high right now, maybe it's making a multi-year high, and it goes along with the factor that we're seeing a cool off in tech. Basic materials are making a 1-month high right now,
Yes.
and in my opinion, I think that regardless of the two roads we're going to go on right now, I think we're going to see a pickup in industrial and basic material stocks, consumer staple stocks, more grounded stocks. And maybe if we don't see a big pickup, James, I think we'll see some stability in those prices, at least in those assets.
Hmm.
So the bottom line is I'm becoming increasingly defensive. I'm taking my helmet and putting it on right now. I don't
Okay.
want to, I'm not going to be a hero right now. I'm not looking for the best returns. I'm looking
Ah,
to reduce volatility for the foreseeable future. And maybe I'm wrong, and maybe things will change and come back, spring back up. And
sure.
that's okay too. The market was overdue for this, but everything I'm seeing technically right now, and everything I'm seeing fundamentally, and everything I'm looking at going forward is causing me to become a little more cautious right now. Just a little more
Okay.
cautious right now.
Okay. So it's curious to me, like the ETF, the copper ETF. I mean, it's counterintuitive to me that it would be experiencing a 2-year high at a time when, by all accounts, industry, which is the primary consumer of primary copper globally, is in a sort of a retractive kind of, I would say, is in a consolidation phase itself. It's in a wait and see mode right now. Industry is not firing on all cylinders by any stretch of the imagination. So what's driving the interest in the copper ETF?
Basic materials, and primary basic material. You see, here's the thing: residential, as you and I spoke several months ago about your deck, how
Mm-hmm.
you had to push it back because the price of lumber has gained 3 times.
Yep.
Well, copper is involved in a lot of residential construction as well. And residential construction is going through the roof right now. And with very, very low interest rates, that trend may continue. So we are seeing, before I'll get back to this topic, but that's one of the reasons why I'm recommending credit agency stocks right now. So there's a lot of copper, a lot of hoarding going on right now, a lot
Mm-hmm.
of potential development going on, and copper is still used in a lot of residential construction to this date. And for that reason, we're seeing a pickup in sentiment. And I think that pickup in sentiment is also moving on because if President Trump regains power, there should be an uptick in industrial production and in basic materials. And also, historically speaking, when you see stock market cooling off, you start seeing a pickup in basic materials and consumer staples. So it's a cyclical thing as well.
Mm-hmm. Interesting. So then where does that leave? I mean, people are so focused on the tech sector. Where does that leave tech in the current sort of malaise? I mean, I'm looking at Tesla, and it's kind of trading sideways. It looks like it's established a new support level at, call it between 320 and 360, but it doesn't seem to be able to break through that, certainly not heading towards its old highs of 520 or its previous high of 520 at the beginning of September.
And I think it will. It's going to take a little time. And as I said, it's going to take a few months. I don't necessarily mean we're going into a bear market. I think we're going into a wait and see zone. I think we're going into cautiousness right now. So I think we may see this trading range in Tesla for some time. As far as the stocks that I'm focused on right now, I'm focused on top renewable energy stocks. I'm focused, as I said, on the credit agency stocks.
Oh, like for example?
Like Equifax, FICO, and Experian. Experian just made all-time highs the other day. That's an over-the-counter stock, ticker symbol EXPGY. And as far as renewable energy stocks, I call them the modern utility stocks. That's how I coined these stocks. I'm not going very adventurous. I'm going into two leaders: NextEra Energy, ticker symbol NEE, world's largest generator of renewable energy, and Brookfield Renewable Energy, BEP.
Wow.
And they're pretty big in Canada, actually, BEP.
Yeah, Brookfield is well, it used to be just around the corner from my office. I'm very familiar with Brookfield.
Yeah, these are not exciting stocks. These are not stocks that are really big on the news headlines. But I think right now, with what we're seeing, I think those would be the safe stocks. And as far as technology, to answer your question, as far as technology, you may or may not remember about a month ago, I explained to you that I think that we saw the bulk of the move from technology. And what I typically do is I don't go from stocks to cash. I go from stocks to ETFs, then to cash. So over the last 3 weeks or so, my suggestion for folks would have been, and I did say this a few weeks back, we start moving to cloud ETFs, networking ETFs. Those ETFs have remained fairly strong over the past month, and they've lost. The average tech stock lost about 10% over the last month, and 15%. The average cloud ETF lost maybe 3-4%. So you would have, the key is to become extremely aggressive during accumulation times and become very conservative during periods of choppiness, because that's when investors and traders tend to lose everything they've made during the upside. So I think the key now is not to look for the best stock, but I think that the key here is to look for the best defense.
I see. Have you heard anything about this new memory called MRAM?
I've heard of MRAM, but not. I know DRAM, but I not in details. No.
Oh, okay. It's the biggest breakthrough in chip memory in the last 10 years, we'll say, and it's starting to really make headway. And I'm just wondering if it's something we should start to look at. Probably not in a defensive environment.
Not in a defensive environment, but I will take a look at it, and I'll give you my view. I'll make a little note here, and I'll take a look at it. And next time we talk, I would love to hear more about it, and maybe have a conversation about it with you, because I'm always looking for new technology. The thing about me is I'm more of a momentum guy, so I wait for trends to develop and then I kind of back into things. Whereas you look for things from the ground up, which is ideally how you should look for stocks. I just don't have time. But very interesting. Something I'll definitely take a look at.
Sure. Okay, Roger. Well, that's great. Let's leave it there for now. A fascinating conversation for me, anyways, as usual. And I'll look forward to speaking to you at the roundtable on Monday or at some other point during the week. Have a fantastic weekend.
Thank you for having me on, James. And you have a great weekend. Stay safe, and I'll talk to you soon. Bye.